pension. If you're ready to take your finances, welcome to the next stop on your journey from paycheck to pension. If you're ready to take your finances to the next level, you're in the right place. It's time to take control of your future, starting now, and we're doing it live. Hi, we're the Stidhams, and our goal is to help you get self-directed. It's the tax-free income that will shape your legacy. It's wealth, time, and the freedom you deserve. What you're about to learn will enable you to make confident and strategic moves. It means gaining complete control to invest in what you want when you want. We've helped thousands of people just like you. And if they can do it, you can too. So we hope you're ready, because it's about time that your money started working for you. And we're so excited that you chose us to show you how.
Starting right now.
Hello. Thank you for tuning in. We've got a pretty cool story to share with you all tonight. Don't we, Donnell?
Yes, we do.
This actually is a good story because, and if you want to hear how a mother and daughter, this is really about multi-generational wealth, living and wealth, really kind of applies to both. But how a mother and daughter teamed up to create generational wealth. And I think it's a pretty dope story. We get so inspired talking to you guys, and I hear the stories of Donna when you're talking to people all the time, and just listening to kind of what they come in with, and then they go, wow, I didn't even think about it like that. And now seeing the difference in what they have available to them now, just with information, it's pretty inspiring to see that difference and that change or shift happen just within a 30-minute call with you, right?
Right. Well, and there's a common theme here. I've been getting a lot of, I'll call it consults with, I'll call the age range maybe 58 to, let's call it 75, because there's a pretty significant range there.
Okay.
And they're all people who have significant income or have assets, but their objective is to transition those assets into a vehicle that can produce uninterrupted compound interest without effort.
Yeah.
Well, mathematically, it may not make sense for a 65, 67, 68, 72-year-old to get a secure compound interest account, because there's this law of diminishing returns, right? Where the cost of insurance compared to the growth, compared to the time horizon, it may not mathematically make sense for you to have, even though you may qualify for an MPI plan, it may not mathematically make sense. And so
Right.
This is one of those opportunities where, it's a standard response from me. Hey, do you have any insurable interest? Well, if you do, here's a way that you may be able to still accomplish your goal by leveraging that insurable interest. So this happens to be one of those examples where that was able to happen.
And I think that the other important part to know about an example like this, if you have tools in your garage, right? You need to hang something up. And I don't know why I'm using this example. I'm setting myself up here. I know I am. Okay, if you have a set amount of tools that you are comfortable with using, okay?
Mm-hmm.
When you need to hang up a picture, right? What do?
Thumbtack.
You use the tools that you know
Push
are going
me.
to get the job done. The pictures are like not even a half of, they're light. They're fine to hang up with that, okay?
Yeah, raise your hand if you hang your pictures with push pins. That's all I'm saying.
I knew I was walking myself into this. Okay, beside your feelings
you
about
finish.
how I hang pictures. By the way, Donnell uses like an anchor for something that could be held up with a push pin or a thumbtack. So let's just throw that out there too, okay? The point is that we use what we know is going to work.
Right.
And just as we're very different in this way. I go for what is easy, right? What's going to do the job? It's not going to cause as much damage to the wall. And you are like, this sucker better be secured up there. Like, no matter what happens, if we had an earthquake in Arizona, these pictures, this 5 by 7 picture is not going anywhere. It's going, the whole wall has to come down for any of this stuff to come down. And I think it's overkill, but for you, you're going, I've reduced all the risk and it's secure.
You do
Yes?
it once, you don't have to do it again.
There it is. And some of my stuff that's hanging up with the push pin is still up, and you don't even know what's back there because you
Yeah,
didn't
but
check.
I mean, it was like this, and then it goes like that, and then it
No, it
goes like that, and
doesn't.
then it goes like that, and then it goes like that. It's still hanging up there. Don't get me wrong,
It's
but
up
the
there,
groove
guys.
that it's made in the drywall, it's hanging up there by a thread. You sneeze, and okay. But anyway,
Here's
I
here's
digress.
here's the point, okay? Here's the point. There's a point here, and it's not just so we argue on the opening of our live stream. Okay,
This is
it's
an argument.
this. No, I'm just saying
Oh, okay.
there's a point here. The point is that you use the tools that you have available to you. If you're comfortable and the most common, secure, this is how I know how to use these tools, you're going to use those tools, right? Well, we do that when we're building out a debt reduction plan or a financial improvement plan, just in general, right? We go for the tools that we know we have available to us. For a lot of people, it's real estate, right? No,
Absolutely.
and you don't even know, okay? It's like I'm up here, boop, the picture's up, and Donnell's like 45 minutes later, he's like measuring like the wind. Bro, just get the picture up then if you want to do it, or let me do it and I'll put the push pin up there and it'll be up. Because
Don't forget the push pin at the bottom that you have. That it's like a ledge. You push pin so it can rest on the ledge of the push pin because it's not really up there. Don't forget about that part.
that was like 10 years ago when I did that. I'm
I can
better
show you
now.
one right now.
Yeah, no, you can't. I'm better now. Okay, Anthony is on LinkedIn. He's saying, "This is me." Which one, Anthony? Are you team anchor for a small picture or are you team push pin? Let's just get it out there. There's a lot of people that probably are push
The
pin
great
people.
debate. Is the dress green or is it blue?
Do you need gorilla tape for packaging? Like Donnell would be like, yes, let's use the super glue on everything. Okay. Point is that this team, this particular set pair, they had their tools, right? What they were comfortable with in approaching their plan to establish generational wealth. And so this is how that's what they were comfortable with. They had their push pins out. They had their anchors out too, right? They had all the tools out, but they were using only the tools that they felt the most comfortable with. And hey, we got some team push pins in the chat. I gotta say, Kelly, that's my girl.
Thank you,
And
Kelly.
yeah, thank you,
She
Kelly.
needed that.
I did. Yeah, definitely need that. Okay, so, Anthony's team anchor. Dang it.
Shocker.
I thought you were agreeing. Thought he was agreeing with me. All right. So the point is, we only use the tools that we know of, right? And that's what we're out here teaching, new tools. And a lot of people have said, "Wow, I didn't even know this stuff existed. Why
Right.
is nobody talking about it?" Well, Donnell, you always ask the question,
Right. What do they benefit? Who benefits from you
who
not
benefits?
knowing?
Right. And so we are talking through what this looks like. But so if you want to jump into it, we can just do that. And then I can add some of my points that I had later.
More anchors and push pins. No problem. So
I'm going to put a pin in this conversation. That's what I'm going to do.
it will come up again at dinner. That's what she means.
Yeah.
So okay, no problem.
No, it will come up again when I want to hang something. And I say, we don't have an hour to hang this. Okay. It's just going to go up.
So to set this example up a little bit, again, it started. I've had several conversations like this, by the way. The did you give the person a name?
Oh, Brenda.
Brenda,
Miss
Barbara,
Brenda.
Barbara, Brenda.
Miss Brenda.
Miss
Yeah.
Brenda. Perfect. Okay. So got a client, and again, this is a consistent theme, especially over the last few weeks, around clients who, again, are between that 57, 58 to anywhere in the 70s who see our lives and see the opportunity that a secure compound interest account presents. And it's like, man, I want one. And I've got clients in their late 60s who are adamant, like, I'm healthy. I know for a fact that I'm going to be here because I've got parents who are still here. So I want my secure compound interest account, and whatever that looks like. And so what I usually talk to with clients around, that are up in age, I'll call it, is you really have to be aggressive. This is not one of those I can do 10 times my age and be able to successfully be able to produce income. So you have to be aggressive. So what that means is if you have an asset that you're able to put in a lump sum to be able to dump into this vehicle, then okay, maybe the math might make sense. And this current situation was, got a client who's 60 years old, Miss Brenda, who was interested in a secure compound interest account after watching several of our lives. And the objective was, hey, I want to use some of the passive income that I have to be able to start a secure compound interest account. And that's kind of where it started. So if you want, we can kind of jump in from there.
Yep, let's do it.
And and I only add this visual just because I know it bothers some people.
Yeah, why do you add it if we could just do a whole black background? Moving on. Okay.
Because I like poking at you.
You sure do.
Like I don't have friends. I don't have any fun with anybody else. I gotta have fun with you.
Yeah. Well, this is so much fun. Golly.
Bottom line is there are several things that we offer. There's several things that I talk through with clients, and I just want to make sure that it stays out in front as to what those options are. And as it relates to Miss Brenda, what was the whole objective? Well, the objective was, hey, I want to grow more passive income. I want my secure compound interest account. I want to stop playing so much in the market. I want to get out of investing and move towards wealth building. And so what does that look like? Again, it boils down to just being simple math. It's being able to reduce risk. So if you can reduce the risk and put your money in a vehicle that can absolutely allow you to be able to generate that wealth, meaning pay yourself first today in an area that's secure, compound your money, and then exponentially grow it. Meaning the objective is, in order to build wealth, you have to eliminate, if not reduce, the risks. Meaning the more secure you are, the better you are. And so looking at Brenda, age 60, she currently has a military pension, and she does have some rental income right around $1,000 a month. And her goal, she came fully stocked and prepared as to what her goal is. Her goal is, I need an additional $50,000 of income. And okay, usually when people are prepared in this fashion, it allows me to peel back the layers a little bit, because I understand you need $50,000 of income, but what do you currently have? Like, if you wave the magic wand and you're currently at that retirement age that you want to be, how much do you currently have, or what vehicles do you currently have in place that are going to bridge that gap? And that gap being, hey, I need $50,000 of additional income throughout the year. So what do you currently have in place? And what we learn is, hey, my plan was to buy more rentals. My plan was to continue down the path that I'm already going. I've got a decent rental that's producing $1,000 a month passively after all expenses are paid. So my thought process was, I'll continue doing that. But after listening to us, hey, maybe there's an opportunity to do this with less effort.
Yeah, let's see what the options are, right?
Right. And so in having this conversation with her, what we learned was, one, what was it? The multi-generational living is what it's labeled. But bottom line is, she lives, she owns her own home, and her daughter lives in her home with her. Her daughter's 30 years old. And again, she has her military pension. She has a rental in addition to this home that's producing about $1,000 a month. And the objective is, she gave me way more information than I was expecting to be provided as it relates to a daughter, but it was good information to have because it allowed me to build a plan B. But the objective was, hey, I want to take this $1,000 a month that I have in passive income and put it in a position such that it's producing my secure compound interest account. So what would it look like if I was able to do that? And so we had a pretty extensive conversation around this. And what was concluded from that was, you know what? If you continue down this path, what does that mean? assuming you would get a comparable rental, again, on average, most people have somewhere between $300 and $700 a month in rental income. 1,000 is pretty good, but let's assume that she would continue down this path. Well, if $50,000 is what's required, it would require an additional four rentals, $48,000 a year, $1,000 a month. They would require an additional four rentals in order for it to be able to achieve that income that she's looking for.
Right.
And that almost sent her off because she acknowledged the amount of work that she currently has as it relates to the rental that she has today. That tenants, the toilets, and the trash. It's
Right.
kind of hard to avoid it. And then in addition, if you're going to add more responsibility, like more rentals, you probably have to look at maybe a management company because again, she is 60, getting up there in age. I doubt that she wants to spend the rest of her retirement years running behind four or five rentals, right? And so the thought process was, what, whoa, getting more rentals isn't the goal. Hey, what would taking this $12,000 a year in passive income, what would that look like if we was to put that in a vehicle somewhere else?
Well, hold
Go
on
ahead.
one second because this is where I felt like a lot of people go, they're doing the math on rentals. They do the math on the amount of profit that they could get per month, and then they go, well, that's obtainable. But here's the part that I don't know that is a part of the equation when they're first thinking about rental income as retirement income. One, some people get into the business because they inherited a property, not because they actually had to go through the process of purchasing this property and coming up down payment or however else they purchased it, right? So that's first. Then there's all of the fees associated with each property. So not only is that income taxed, so it's not tax free. It's not actual retirement income where you can have it be tax free most of the time.
Right.
It's going to be taxed, not just taxed because it's income coming to you, but then the properties are taxed as well. And those properties, even though the property taxes can be capped, those are things that people don't necessarily consider, but it cuts into your profits. So if your profits are taxed and your property's taxed and you have repairs to do on this and you have to pay a management company, then how much are you actually getting back from this rental income, right? How much is actual income after all of the headache? I was looking up for where we live because I saw a ton of people posting recently about this. There's a tax hike for property taxes, and there's a cap, so they can't just make it whatever they want, right? They can't do that necessarily. It's like capped at 5% increase per year, whatever that looks like. But you keep going year after year, right? If this is supposed to be your retirement income, then you can see where this is going. The problem wasn't necessarily how much, what the rate is or the increase in the rate. That wasn't the problem. The problem was that all these people moved from California to the Phoenix area, because that's where we are, right? And the property values went up pretty quickly, right? So if the average if the average rate is about 99 cents per $100 of assessed value, if your property value just doubled, so did your taxes,
Absolutely.
right?
Absolutely.
And that's something that you can't necessarily control. You wouldn't want to paying less in taxes means that your property has depreciated, and that's not a good thing, right?
Right. And the argument to that would be, well, I'm just going to raise rents, right? But there's this diminished return. You can only raise rent so much over a certain period of time, and it doesn't necessarily equate to or compensate for that increase in property taxes either. So you're right. There's a lot more expenses, and just so we're clear, this $1,000 a month is after all of that.
Okay.
So I want to say the rent might be 2,200 or something like that, 2,400. It's a significant property, and I think the objective was being able to get a few more of those. And again, as it relates to her objective of $50,000 a year in additional income, her time horizon was 15 years. So she's 60. So she understood that. What I appreciate about this conversation was she didn't call me going, and I need that 50,000 in 3 years. She was
Right.
a bit realistic around, you know what, I understand that it takes time. I've been watching your videos. I understand that it takes time for that compound interest to grow and for it to significantly turn into something. So I need some compound cycles, was the words that she used, which again, I love when people throw my words back at me, which tells me she understood how this process works. So she was very adamant about, I'm okay with it being 15 years for me to be able to hit this goal, but that is the goal that I'm looking to hit within 15 years. And my assumption was we were going to focus on this rental property. My assumption that the conversation was going to transition into, well, what is the balance owed on the mortgage? Is there an opportunity to do a second position HELOC? Blah, blah, blah. Let's do velocity banking. Let's access the equity in this home to be able to figure out what this is going to look like for you. But we ended up going down a different path, mainly because she has other leverage in addition to the fact that she has this rental property.
Yeah. Okay, let's get into it.
So, in looking at her specifically, yep, there we go. In looking at her specifically, I know it's a little bit small. Giving her $1,000 a month, the objective was, hey, what can I do with my rental income that's bringing me $1,000 free and clear every month? What would that do for me inside of a vehicle like MPI, inside of a secure compound interest account? So I said, okay, let's take a look at it. And sweetheart, if you want to jump over to the calculator real quick, I'll show you. $60,000 inside of the calculator at $1,000 a month, again, is right around $24,000 tax free for life by the age of 75. Now, again, her time horizon is 15 years. She needs $50,000. We are short. We're short by half. So clearly, she could put away $2,000 a month and achieve that $50,000 a year, but that is not what we discussed. She did not have $2,000 available. Now, again, I thought we were headed down the path of, okay, well, then what if we put in a lump sum? What does it look like as it relates to your rental property? But she's very happy with the property. She doesn't want to access any more. And again, this $1,000 a month would achieve what? It would be buying a life insurance policy of about $180,000. And she would have cash value created at around at age around 75 of a $288,000, and a death benefit of about 648. Pretty good. But during this conversation, her daughter actually walked by the camera, and again, she had mentioned that her daughter lived there, but it's not like I'd seen her. There was just no reference. And when she walked by, I said, "Well, have you ever thought about insurable interest?" And she goes, "Well, what does that mean?" I said, "Well, I understand that $1,000 a month is what you have available. So $1,000 a month for you over this 15-year period is $24,839. What if you leveraged your daughter and you did an MPI plan on her?" And now understand this. At age 30, she's too old for her mom to actually own a policy on her, but she absolutely could fund a policy for her daughter. And again, the daughter being 30 years old, and turns out her daughter's an RN. Registered nurse, makes about $115,000 a year, great income. So there's no harm in Brenda funding an MPI plan for her daughter. So what would that look like? So at age, with her daughter being 30 years old, so doing the exact same dollar amount, the exact same $1,000 a month. Oh, hold on, I'm gonna go here. At 30 years old, doing the exact same $1,000 a month for 15 years, which means her daughter would be 45 at this point. What does that look like? And again, it was 24,000 for a 60-year-old for 15 years. What does it look like for a 30-year-old? Well, it's almost double, 40,000 in tax-free income in the same 15-year period. Well, but why is that? Why is it so much more for a 30-year-old as compared to a 60-year-old? And the moral of the story around that is it's the cost of insurance. For a 60-year-old, we were purchasing about $180,000 in life insurance. Before a 30-year-old, that same $1,000 a month, based off the lower cost of insurance, meaning it costs less to insure a 30-year-old than it does a 60-year-old, you're able to buy more life insurance for that same $1,000. And that equates to more cash value, which ultimately equates to more income. So at a minimum, just doing the policy on her daughter would allow her to get closer to her goal. Now that's still not the goal. The goal is 50,000, but 40,000 is $40,920. I call it pretty close. But I asked a very simple question as the daughter was walking by. If you want to slide back over to the other
Yep, got
to the
it.
whiteboard, I'd asked her a question as it relates to her daughter. What would happen if, or not what would happen if, have they ever had a discussion around her daughter retiring early? Again, she's an RN. I've got a lot of RN clients, so I know through COVID, one, they've made a lot of money. Two, they've been working pretty dang hard, and there's a lot of income being made in this industry. And so what I asked was, has she ever given the thought to being able to retire early? Well, what does that mean?
And they burn out fast.
Absolutely. And so retire early is absolutely a goal for a lot of the people in this industry. And again, because I've been working with so many of them. And so her mom goes, well, what do you mean by retire early? I'm saying, well, as of right now, she's 30 years old. On the path that she's on, 9 times out of 10, she's set up to continue working until she's 65, like most of us. Well, if she were to take the same approach you are, again, she makes $115,000 a year. 10% of her income is right around $1,000 a month. What if she too applied $1,000 a month into a secure compound interest vehicle? Meaning, not only does mom fund $1,000, but what if mom and daughter funded an MPI plan on the daughter for $2,000 a month? So all I'm doing is adding, half from the daughter, half from the mom, putting it together and dumping it into secure compound interest account. So what does it look like to produce $2,000 a month between each one of you? And understand this, I get it that mom needs income. The whole objective is $50,000 a year in income by age 75. Well, that would have to be an agreement between the two as to how that income will be distributed. Now that's not a conversation for me to have, but my point is this: in leveraging the low cost of insurance on her daughter, you can actually produce more income. So if you slide over to the calculator again, what would it look like for a 30-year-old putting away $2,000 a month?
Okay, well, I did make a graphic for that. Just throwing that out there.
I know. So if you were to put away $2,000 a month, bruh, what does that look like? So again, by her age of 45, which would be mom's age of 75, we're talking about $81,840. And again, if let's say the agreement was, hey, at age 75, this split would look, instead of it being 50-50, maybe that split looks more like 70-30. 70% of that 8140 goes to mom, the remaining 30% goes to daughter. And 70% of 81,000, what is that? 56,000. And the remaining 30%, which would be another 24,000. So 56,000 going to mom. That's the 50,000 that she was looking for. And the remaining 24% going to her daughter. What, is that comparable? Is that realistic? And so what's happening here? Well, that $2,000 in premium contribution every month is producing a life insurance policy of around $1 million. It has liquid cash value in that 15-year period of 718. But look at the death benefit. If something were to happen to the daughter, now we're talking about legacy for the rest of the generations. But the bottom line is, this is a pretty significant difference. And that's at 45. So if you slide back over, if we were to do the same thing at age 50 or 55, what does that look like? Well, it goes from $80,000 at the daughter's age of 45 to more like $150,000 by the time she turns 50. And what that ultimately means is, again, at age 75, if we were doing like a 70-30 split, we would be talking about $56K for mom and another $24K for the daughter. But if we were to do something like that here, now she could just take her $50K right off into the sunset, and that leaves another $100K available to be able to do whatever you want. The moral of the story is, at $2,000 a month, which again, 10% of her daughter's income, which is, I'm not going to say easy to do, but it's a bit realistic to do. And you've got this rental property that's making you $1,000 a month. Combining those will allow them both to be able to look at what would retirement look like at age 55 for her daughter, at age 50 for her daughter. She could replace her income by 50, and by 55, what is it? $245,000 tax free for life. $245,000 by age 55. Whereas as of today, retiring early isn't even an option. Retiring early isn't even on the radar. But by the two of them working together to accomplish a goal, meaning the goal for the mom to achieve $50,000 and putting her daughter in a position to be able to retire early, it's kind of a no-brainer. And there's so much that has not been discussed here.
Right.
There's so much opportunity that's kind of being left on the floor. Because notice, I assumed we were going to be talking about using the equity in the home, but I didn't even bring that up.
Right.
Like there was
you don't
no
even
point.
have to.
Didn't need to. But I want to highlight something here that's not even mentioned. What if initially she would have said, you know what, I'm done with these rentals. And in working backwards, for her to be receiving $12,000 in income means that property is worth somewhere around $400,000 to $500,000. I would love someone to challenge me on this, but I spent a little bit of time just trying to understand, because $12,000 a year in income on a rental property, that's significant, especially after taxes and after all, after the mortgage and all of that stuff. So if it's worth somewhere around $400,000 to $500,000, or meaning the mortgage is somewhere around $400,000 to $500,000 when she bought it, that means the property can be assumed that it's worth more than that. So I took a conservative $300,000 in profit, meaning what if she would have simply had $300K available off the sale of the rental property, and if she would have taken $200,000 and distributed that over the next 15 years. So why 15 years? Well, think about it. Right now, her time horizon is 15 years. And so if you were to divide 200,000 by 15 years, you would end up with about $13,330. So $13,000 a year. So now you take the 200,000 and you spread that across 15 years. Now she didn't lose anything. Remember that $12,000 that she needed to put into her secure compound interest account? Well, you've got $13,000 over that 15-year period to do so. So, okay, there's no miss there. Now you've got $100,000 left over. So what do you do with this $100K? Well, what if you take that additional $100K and dump it into the secure compound interest account? Meaning, instead of just $2,000 a month, what if it's $2,000 a month plus $100,000 lump sum, which is 50 in year one, 50 in year two? And notice, I don't have her making any more money. I didn't pull this out of anywhere other than selling the rental.
Right.
So getting rid of tenants, toilets, and trash, taking the $300,000 profit. And again, I would love in the comments to challenge me on whether or not $300,000 is realistic. What I've concluded is for her to be receiving $1,000 a month, free and clear in income, and the rent is somewhere around $2,200 a month. On a $2,200 a month property in Florida, I assess that the property has to be worth somewhere between $400,000 and $500,000. Now, depending on where she is on the amortization schedule, that's the argument as to whether or not this would be a $300,000 profit. But my math says if you were to jump over to the calculator and dump in an additional $100,000 one time,
okay,
what does that do? Oh, that's too many zeros.
Well, I honestly think this could have been her home and she ended up moving in with her daughter. And so that's where, there's such a big space for that profit to exist.
Yeah. But there's so much here. So
Well,
if you were, go ahead.
Oh, no, I'm going to say it after. You go ahead.
So if you were to do this, again, dump that 100,000 in one time. By age 45, in that 15-year period, we're now talking $124,000 in tax-free income. Mom wanted 50,000. Well, she just got 60. How about 62? And her daughter wasn't expecting any. How about she gets 62 as well?
Right.
And so What can her daughter do with that $62,000 that she wasn't even expecting to have? And what kind of position does that put her to set her up even faster to be able to retire early? And so when you add an additional 5 years on that,
And 5 years, because we're really only talking about two compound cycles with their time
exactly,
horizon. If you let it
exactly,
compound one more time,
exactly. Now we're talking, again, 50-50, $110,000 each, all because we looked at that rental property a little bit differently.
right?
Because again, $12,000 a year. Okay, maybe in 15 years, rents might have jumped up to $1,800. I mean, maybe the profit might have jumped up, instead of being 12,000, maybe be 18,000,
Right.
because the rent's jumping up over that time frame. So I get it. There's still some growth that's going to happen in this property, but look at how much effort was involved in just simply getting rid of that rental property, dropping that rental property in, or the return from that rental property, a third of the return from that rental property into a vehicle like this. I didn't even dump 200,000. Like, imagine if I'd have done that. What if I'd have dumped in all 300,000? Like, there's so many different plays here that can be made, but being very conservative puts them in a position in that 15-year period to be able to achieve goals they didn't even know they were able to even reach. Go ahead.
Yeah. Well, what I was going to say is I'm actually not mad at people owning property because we're not going to make more land.
I agree.
So
I agree.
I'm not mad at that, and I really do appreciate those who are willing to, you know, go out there and obtain all these properties, because I just feel like if they're not doing it, then investors are doing it.
Right. I
And
agree.
then this is where the problem happens, where we can't find affordable living, and the next generations coming in, they get all of these really high rental rates because they all, of course, bought at the top of the market too, where you buy. For her, she may have purchased this house 30 years ago, and even though its value has increased, the balance has gone down. So there's that space, there's an opportunity there that wouldn't exist for somebody purchasing a home today or
Absolutely.
buying a new property, right? So I do think that there's some different variables here. The Another opportunity, though, here is to think of, if this is a strategy for generational wealth, if this is a strategy for teaming up and building a family bank, because that's really what we're talking about.
Right.
They're building a family bank that says, look, if she doesn't need the 50,000 this year, she doesn't have to take it, but it still exists,
Right.
right? If she needs 75,000 this year, it exists for her. And that's, I think, the most powerful thing. Her daughter can't remove anything that would be needed or necessary, let's say a medical expense. She couldn't take that out of her retirement accounts through her employer without a penalty.
That's right.
She couldn't leverage to purchase another rental property if they did want to continue adding rental properties. She couldn't do that without a penalty, and further penalties to boot, because it's still taxable
Right.
income, right? All of it's taxable.
Yeah. All of this is being done before the age of 55.
Yeah.
It's pretty powerful.
And it's passive. I think that's the other part, is people equate rental income, rental properties, being a landlord, with passive income when they're retired, and then they learn later on, oops, it's not at all. It's not at all, and they don't like it. And I don't personally want to be in a position where I can't manage a property. I'm not going to be calling all of the people to fix things and manage it in that, actively manage it in that way. And now your profits are gone. Because what else are you going to do? Sell
But
them.
but let's go a step further though, because a lot of the clients that I'm running into lately, they acknowledge that, hey, I am 68, 75, 79. I'm up in age, and I am now transitioning these properties over to my adult children, learning that my adult children want nothing to do with these properties
But why?
because of the work involved.
Well, they don't value owning property like the same way that their parents' generation do,
Oh,
first
very
and
much so.
foremost.
Very much so. But my point is, unless you were brought up in this industry, in this space, and you understand the work necessary to all of a sudden be handed four properties and now go manage them, that's a daunting task. So what do
Yeah.
people end up doing? They end up selling them. And so rather than selling them, taking that capital gains hit and all of the impact associated
Yep.
with that, there's a better way. There's a better way to maybe turn that income into a vehicle, into a machine that can now distribute income for generations. Because what we're talking about here is the opportunity of putting Brenda putting her daughter in position such that the generations after her daughter will never have to be concerned about income again.
Yeah. Well, those are important things to note. The capital gains and all of the other penalties on this side of things, inheriting. There's no way of getting around it, and unless you're properly structured through a trust, then there's no way of them getting around it either. And that is why they're encouraged. Matter of fact, I read something today. It was instead of selling it for market value, it was, what was it called? Fair market value, or it was some lower value, some way that it was valued lower, and it was still acceptable to the bank or to the government that you sold it at this rate, right? And it's only so that you would pay less in taxes. But imagine that. Now you think you've left $1 million property to your kids, right? They've inherited this asset. And in order for them to be able to even afford to do anything with it, they have to sell it for less than what you even value, what it's actually valued at, because they can't afford the penalty. It's like
Yeah,
when Oprah gave away all those cars, you get a car, you get a car. And then people were like, oh my gosh, yay. Holy cow, this is amazing. Thanks, Oprah. And then they learned all you got to do is pay all the taxes right now. Just write a check for the taxes for this free car and it's yours. And they were
there's
like,
a
wait, no,
yeah
I
that
can't.
wasn't in the cards.
Yeah, I can't
Oprah
do
didn't
that.
say now you have a new car and you get to pay taxes. Right? But I mean,
Yeah,
this is I'll call it a real estate hack on depreciating assets to reduce the amount of tax that you end up paying. I mean, it is absolutely a strategy applied to making sure that your inherited properties aren't impacted by that. I mean, and again, you brought up trust. There are many different ways to make this easier. This is just one, I'll call it one small step in, hey, here's a different way. There are many different traditional ways of going about this to make this easier as well. I think what shocked me though, I wasn't expecting that $50,000 in year one and year two to have such a significant impact. Like, man, had I taken the approach of if we look at this rental property a little bit different, is there a better opportunity? Because I didn't even bring up a second position HELOC. Like there's
right.
so much that I didn't introduce where there's so much opportunity here to turn this into a huge income producing vehicle for both of them, to allow both of them to, and again, she had a 15-year horizon. We could have backed that down to 10 years
Right.
and still hit
Easily.
the goal easily.
Right. Yeah.
So there's just so much here. And my point is this: there's a lot of I'm talking to a lot of people who, at their age, have assets, have the income. It's just that they don't have the time horizon. They don't
Right.
have the health. They don't have the age to be able to give their money the right amount of time to be able to produce the income that they want. So the key is there insurable interest elsewhere? Is there a way to leverage that insurable interest to be able to still hit your goal? That's the whole point and goal to this, at least for me today, was just to step back and take a look and see if there's another way to be able to leverage this.
And get creative. Are you willing to make some changes, like live with have multi-generational living? So whether if it's having your kids live with you longer, and make that a part of the plan. So it's less about this is what they need to do or have to do, and wait until it's a need or have to do. And now it becomes a part of a strategy to get everybody on a better footing, going out the door, or just this is what it needs to look like. Because at some point, either she's going to burn through her resources living on her own, right? they're both just paying just to live on their own. And so if this makes more sense for them and that this is something that they can do, not everybody can live with their parents,
Right.
right? Not everybody has the relationships with their family to be able to have this kind of arrangement, but some people do, and they just hadn't thought of it.
Right.
Maybe we just team up and build wealth. We have some questions. Do you want to?
Yep. But real quick, you brought up something that I think you might actually be right. And again, I tend to not dig into details that don't apply to the math that's already in my head. And so I think like the fact that they have this property and she makes about $115,000 a year, she makes great income. Why
Right.
would she be living? She makes more than enough money to be living on her own,
Yeah.
which says this probably was a choice.
Right.
And that rental property probably is the home that she was living in or the mom was living in, vice versa, whatever it ends up being. And so they had already made the decision that, hey, mathematically, it makes more sense for us to team up and share some of this expense so that we can, both benefit from it in the long run. And since they were already headed down this path, that's what made this process a no-brainer for them. So I think you're absolutely right about that.
Yeah, it definitely seemed like it was a strategy move
Yeah.
as I was looking at it.
Because they definitely didn't fight me about it.
Right. Yeah. Miko says having a management company isn't an option.
Oh, absolutely it is. But it's also an expense. So for instance, she has one rental property making $1,000, $1,000 a month. You throw in a management company. What is that? An additional 300, maybe
Yeah.
250. I don't know. It depends on where you live, maybe. But now that's less money that you have available. So yeah, I agree with you. She can still get those 5 rentals, and there's still going to be a cost associated with that as well. I agree.
Yeah. And it
Finding
is a
good
lot of
tenants, yeah,
work.
absolutely.
And finding good tenants. There's a lot of variables in there that can impact things for sure. Even just the condition of the home. For a lot of people, having to replace one roof could completely take out what they thought their profits were. And depending on that income, if you're using it as this is extra, this is just icing on the cake, great for you. But if this is income that you actually need to have and you need to have security, you can't control what the market does. You can't control a lot of factors. Even for some people, natural disasters, especially living in an area like Florida or where those hurricanes and a lot of those natural disasters happen, for a lot of people, that was their income.
Right. And I again, there's so many different angles here to use, and I kind of intentionally kind of left a lot of them open because I don't know that there's any wrong answers here.
Yeah. Ken, I like your comments. Oh, so great. Okay, so we've gone over the example. If you guys have any questions, please put them in the chat. We'll pull them up and we'll go into the Q&A. I think we need to talk about this more though, because I just feel like there's a lot of people who are recreating the wheel or the assumption is you go out there on your own and you have to start from scratch and see how far you can get on your own because it's everybody for themselves out here and that you have to do this work. When you get married, then all of a sudden it becomes we're teaming up to try to do this together. That's really the only socially acceptable form of teamwork in that way. You get a tax benefit for it. You get other perks like that. But I think there needs to be more of this. Other cultures do this, and this is why they thrive, right? But what you just walked everyone through, I see no different as adding an unauthorized user on a credit card. You're able to take someone else's credit, like your parents' established credit, add your kid as a user, and now all of a sudden they have jump started. They have a running start at developing credit, whereas somebody who does not have that opportunity, just that one thing,
Right.
it can game changer for people, right? And a lot of people don't even know that that exists.
Right.
You
And there's
guys all do though, right? Who watch us, you guys know that that exists.
and there's two things being leveraged here, right? There's time and there's health.
Yeah,
Because the piece that again it's glossed over. It's not just that she's younger. It's that, hey, at her age and health, she has a better rating, and therefore it's the cost to insure is cheaper. And in order for MPI to work, I want to make sure this is 100% clear. In order for MPI to work, in order for a secure compound interest to plan or policy to work, you have to give your money time, but you also have to be healthy throughout this process. Meaning, in order for the jumps to occur inside of your policy, okay, so what does that mean? Well, when you're putting in the initial $2,000 a month, you are qualified for a certain amount of life insurance. Well, as you put in that $2,000 a month and as the leverage starts to kick in, you start approaching that MEC limit. You start approaching that maximum amount of life insurance that you've already been approved for. Well, guess
Yeah.
what? That doesn't mean you have to get another policy. That means we have to jump the policy you have and purchase more life insurance. Well, in order to do that, the life insurance company just needs to confirm that, hey, your health hasn't changed, or it's not, your health hasn't changed to a point where you're no longer qualified. So that process or being a part of that process means you have to make sure that throughout this journey you are healthy. So who's more likely to be healthy throughout this 15-year time frame? And so you're leveraging the health of this individual as well. And that's very, very important in a process like this.
But it's a family bank. And when somebody gets sick in your family, it doesn't just impact that one person, it impacts everyone. Financially, often financially, but also emotionally. So I don't see how, if we can accept that. We can accept that if somebody were to have a chronic illness and come down with that everybody has is impacted. Now it's a family venture to support this person, to help this person. And I don't know if this is the right time to say it, but I think it's powerful and it's meaningful. There was something that I had seen, and I had sent it to you while we were on our way, because we knew you were preparing the boys for to be pallbearers when we went last week for your uncle and your grandmother's funeral, and to what this means and why this role exists, and the honor that, because to them they haven't attended very many funerals, so they were just kind of like, okay, we're doing it because you said we're doing it, but we don't really understand why this process exists. And I saw this this meme. Do you remember? Do you remember it? Let me see if I can quickly pull it up. It was around. It takes 6 people to carry. What was it? Let me see if I can find it. You want to answer some questions, and I'll bring it back up.
Sure, no problem. So let me make sure I see them. Yep, I see one. So Valerie had a question. Does that process require another health screening? So jumping a meaning the best thing you can do is max fund your policy as quickly as possible. So let's say you didn't. Well, whatever that room is between what max funded looks like and where you currently are, then we will end up having to jump to get to that point so that we can add more leverage. Meaning all we're doing here is the more leverage that gets included into your policy, the closer and closer you're getting to hitting that MEC limit. And so we just have to jump the policy, apply for more life insurance so that we can continue adding more and more leverage. So does that require another health screening? It could. If we're just doing a relock, it won't. But if we're jumping the policy, meaning if we are going through and applying for more life insurance, well, because we're applying for more life insurance, then yes, the life insurance company just needs to make sure you are still healthy. But let's say you're not. If you're not, does that mean you now lose the policy that you have? No, that is not what that means. What that ultimately means is you can't qualify for more life insurance, but you still have that leverage available. Well, then what can you do with this leverage if you can't buy more life insurance with it? Well, the same thing you can do with any leverage. You can do infinite banking. You could apply that leverage to other policies, meaning you can max fund your wife's policies, max fund your husband's policies, max fund your kids' policies, do policies on your grandchildren. There's many different things you can do with that leverage. You just may not be able to add it as in create more life insurance for yourself. So hopefully that answers that. And then Henry had one asking, would you be able to, or Yeah. Would you be able to draw from it? I'm assuming that's also asking how. Like, how are you able to draw from it? What is that process? Well, in this scenario, if we're talking about a life insurance policy on the daughter, and it's being funded by both the daughter and the mom. Well, because the life insurance policy is on the daughter, any income generated, the daughter is the owner. Because she's the owner of the policy, any income generated in this policy is owned by the daughter. So if the agreement is mom will get 50% or 60% or 70% or whatever that income is, that's an agreement that they would have to work out. But how does she get income out of this policy? It's a policy loan. It's an indexing loan. And so ultimately it's going to her online account and putting in whatever that dollar amount is that she wants at that time. And in 3 to 5 business days, that money's then transferred to a checking account, and how it's distributed is how she decides to distribute it. It could be a one-time lump sum. It could be monthly. It depends on however you would want to go about it. Yeah, I assume how is kind of what you meant. Hopefully that answers that. So.
Okay, I couldn't find it. I don't know where I sent it to you. You know, we send stuff to each other like on every app possible. Just forward it on over. Did you
It's in
see
my
what I sent you?
DMs.
Yeah,
It's in my DMs.
that's right.
You
But
stay in my DMs.
I do.
Get out of my DMs.
The sentiment was it takes 6 people to carry you when your time is over, right? But what if you had 6 people supporting you
Right.
and cheering
While you're
for
here.
you while
Exactly.
you're here, right?
Exactly.
And that's really what I'm talking about is usually when people say, you say, what is your goal? And they say legacy. This means that there's nothing, right? It's baseline until you leave this earth, and then all of a sudden there's a benefit,
Right.
right? So I'm going to do all this stuff, and they're not really going to be involved. There is no family bank. We're only cashing out at the end.
Right.
And what we're trying to do is shift that because it should be a family bank. This should be an involved process of them also learning how to build wealth too. Just seeing the power in shifting it from insuring a 60-year-old person to a 30-year-old person. What does she care when really she's the beneficiary of all of this?
Right.
They're already strategizing together. They're already trying to make these moves. So if you can improve that process, if you can speed that up, I had put on the list of bonuses that she could do the traveling assignments, increase the income to
Right.
move
To
her
fund this.
retirement, goal up.
Absolutely, and just to kind of play that out, because you're spot on. If she, participated in the traveling nurses program, where I have a lot of clients who do, which means there's an increase in income, which means now there's even more income available to be able to hyperfund this her MPI plan to not only include the lump sum. Like you're absolutely right. Now we're talking about a potential of retiring age of maybe 40.
Right.
There's so much opportunity here. And I think the other piece you touched on is this is a paradigm shift. We were born into this world alone, and when we hit 18, we're supposed to go out into this world and forge our own path. Well, mathematically, that doesn't necessarily make sense today. So you're right. What does it look like if households started functioning as their own corporation? You've got a board of directors in the household, and everyone plays a role. And the main objective is to build income for the household. And so everyone is leveraging each other on how to build that. So I think you're spot on with this is different, and there's an opportunity here to be able to leverage each other inside of this space to be able to build wealth for all of us. Because once this train starts moving and it starts moving effectively, we're talking about secure, uninterrupted compound interest for life.
Yeah.
It's a game changer.
Well, we've seen this happen before, and we've actually had these conversations with families before, and not everybody's on board. And not everyone sees this as how can I contribute? They see it as how do I benefit from this
Right.
process?
Right.
And that's even a mindset shift too. Because if they're thinking, well, I have to take care of me, well, what is my piece and what do I have to put in and what am I going to get out? And I could totally understand that question for sure. But I think just how we're programmed in general, you can't bring that same programming into a situation like this. I'm not saying leave yourself vulnerable. I'm not saying any of that. But I would love to hear what you guys think about this concept. Can you do this as a family? Can you see yourself having this conversation to say, okay, who is the healthiest, right? Which people can we do policies on? It doesn't have to just be one person.
Right. Right.
The math's either way. It's just how
And
much does it cost to insure and trying to get that cost down, and how do you structure this based on the family? Now, does this mean that maybe there's some risk factors involved, like somebody comes in and they marry into the family? Now, are they a part of the bank? There's a lot of questions here, and I think this could be a whole series of how to break this down and how to structure this, and maybe even talk to some people who help people establish trust, because that could help with creating some of that framework around it. I think that's the best solution.
absolutely. I think I saw a question earlier that I don't know that I answered, and it was, and can she have can she have an additional policy? So she's got this policy that's working. Can she have an additional? And the short answer to that question is yes. Now, I would challenge, does she need to get another policy? Because you can just max fund the one that you have, but you do have the ability to get others. And yep, Mike's question, are the lump sums only at the beginning, or can you add more large chunks down the line on top of the monthlies? And the short answer to that question is yes. The calculator kind of shows it as a lump sum up front. And just so you know, the calculator will split that lump sum in half in year one, half in year two. But you absolutely can annually, you will have the ability to make adjustments to your account. So whether that's adding more lump sums along the way, or adding it this year, not adding it next year, and then adding a lump sum the year after that, you have many different options, because what happens is annually the enrollment period opens and you are able to make those types of adjustments. If you don't make any adjustment, the enrollment period closes and we move on to the following year. But annually, you would have that capability of being able to do so. Why annually? Well, annually because starting in year three, when the relock feature kicks in, just because the relock is available doesn't mean you want to put all of it into your policy. You would have the ability to take that relock feature and do whatever you want with it. Maybe you want to take that relock feature and open up policies for other people. So because the relock feature, the additional leverage that's added at year three on in perpetuity, you have the ability to decide where you want that leverage to go, whether you want it to all go into your policy or not. So as a result, yes, you have the ability to add more. The key is, if you're wondering whether or not this is something for you, the key is to max fund your policy as quickly as possible. Why is that? You max fund your policy, now you're putting yourself in a position to where you don't have to worry about whether or not you're still healthy or whatever the case may be, because you've maxed funded this thing to where you can't get into it. So now it's just about growth.
Yeah, and you're taking advantage of time and compounding cycles, right? Like that's really the key factor is time.
Absolutely.
Okay, can Askia be used as a family bank?
100%. When we're talking, family bank implies infinite banking. Infinite banking can be done with a properly designed cash value life insurance product. So whether we're talking about a whole life policy, variable life, if it's properly designed, you can do infinite banking. So can you use MPI to achieve your family bank? 100%. As a matter of fact, I can venture down the path to say it's better than using a whole life policy to do so.
Here's the part that we don't actually get to hear when people are saying what their goal is and what their plan is to reach some sort of financial security. We don't hear what is it that, like, if you're putting all your money in rentals, whatever those vehicles are, even some people who are putting their money in a 401k IRA through their job, whatnot, we don't hear, is there also life insurance? Is there also a benefit so that if something were to happen to you, and do you understand what a term policy means, which is good for that term, right? But then when you start to get older, what does that actually mean for the money that you've put into that policy and the money that you've put into all kinds of insurance? This is the part that blows my mind. We pay insurance on a car if we get in an accident, right? We buy insurance and pay for insurance on our home if something were to happen, and we need insurance to cover it. We are guaranteed that our time is going to end. That is the one thing that we're guaranteed. And it is the top thing. Number one, we are the least prepared for.
100%.
If that's the case, then we have to start looking at this a completely different way. Instead of we have all these assets that we now need to insure in case something happens to them. We're the asset. We're the asset. And that's the only difference. There's not a risk in doing it this way when you have something that is structured in this way, because as we were go back to that wealth equation that you had up earlier about let me find it. It was with the risk and the security. Yep. There isn't anything out there that checks all these boxes.
Right. Well, there are very few things out there that
Okay,
check
fair.
all of these boxes. And depending on how the market is functioning, there are things that bounce back and forth between both of these equations. So you're spot on. And you said so much. I think the biggest piece is it is absolutely a paradigm shift because we don't initially think this way. We don't inherently function this way. And why not? And I think what this economy is showing us is we need to take a look at how to better function this way, because most of our adult children can't afford homes. They can't
can't.
afford to buy their own place. So what do they end up doing? They end up renting. Well, who are they making rich by renting? So if there's an opportunity to, I'll call it, achieve that generational living.
Ooh,
as
say
well
that
as
again.
Multi-generational living.
No. Multi-generational.
Yeah,
That was fun. I'm gonna clip that out.
you needed that.
I do. Yeah. I like that.
Do I need to go back to the push man?
Putting a pin in that. Yeah. You beat me to it. Dang it.
So with the multi-generational living, if we can focus on how to really get the most out of an opportunity like that, because that's exactly what this is. We're leveraging each other the same way banks have been leveraging us as well. And you brought up another point around we insure our car for what if, we insure our home for what if. What about insuring our income? That's really what we're doing here. We're
Right.
insuring our income. We're leveraging our life to insure our income for the what if. If there's a situation that comes about and we can no longer achieve the income that we thought we were going to achieve in retirement, we now have an insurance policy such that we are able to leverage it to be able to produce that income and bridge that gap.
Yep. Okay. Greg has a great question, and then Laura has one too. What if the owner? Hold on, let me make it bigger. What if the owner died? Not the policy that the policy is on. What happens? I think he means like if you've picked somebody in the family, they have the policies, right? Then what happens if they pass away?
Right. What if the daughter passes before mom?
Yeah.
Well, the policy owner is the daughter. The beneficiary, I would hope, would be mom or a trust. And so if she were to pass, that means that death benefit now rolls into that trust or all goes to mom. So it still ends up being a generational wealth type opportunity. What if mom passes? Meaning the policy is on the daughter and mom passes. Is there anything so that's where it would maybe make sense for the 60-year-old, 75-year-old, 80-year-old to have some type of term related policy for that. So I can justify a term policy for that, but it just doesn't mathematically make sense for a secure compound interest account to be on someone whose time horizon may not be as lengthy.
Well, what's the term policy going to be though? Because how could she could leverage anything she needed out of this policy, and it's going to double every compound cycle. It'll perform way better than any payout that she would be getting from her mom's policy.
So you didn't ask me if it was necessary, because I think that's what you're asking. Is that necessary? It may not be necessary. I'm just saying if you were wanting some type of, I'll call it security around, hey, because I think long-term care is one that I'm getting also by
Oh,
a lot of my, I'll call it
yeah.
older clients. So
Mm-hmm.
maybe it's less about a term policy and more about a long-term care type policy in case things make a turn for the worse, and there's money available there to be able to pay for whatever that nursing home or medical care might look like. So
Man, and these things happen so fast. You do not have time to go apply for a HELOC. You don't have time to go and really discover your options. We need to be able to do this. And here's the most fascinating part about this. Everybody has this opportunity available to them. Probably 98% of people have this opportunity available to them, and they have the whatever their resources are, just restructuring. I like to use the furniture in the room analogy. Like, it's the same room, it's the same furniture. You're just readdressing where the things go, and then all of a sudden it's a feels like a completely different room, and it functions differently. And that's what we teach with these strategies, is it's starting with what it is you currently have. Then you learn what these new other strategies are, how to use them, and then you go, okay, what of those fit me? Because it's not one size fits all. So you have to learn how do they fit inside of my profile. Okay, you want to move
Laura,
on to
yeah,
another
Laura.
question? Okay. Laura says, what is the best way to max fund an MPI account at 56?
Funny, I met with Laura, and again, I assume her name is Laura Garcon. And when I said it, she
Garcon.
was like, got surprised, like, Garcon, like you said it right. Like,
Oh,
most
well,
people call her Garcon.
good on you.
So, okay, what is the best way to max fund an MPI plan at the age of 56? So, everyone has a maximum amount of life insurance that they qualify for. It's your income based off a multiplier. So I think from age 50 to 60. Don't quote me on this. It's either age 50 to 60 or age 50 to 55, and then 55 to 60. It's one of the two. But from age 50 to 60, I believe that multiplier is 20 times your income. So if you make $100,000 a year, 20 times your income would be $2 million. So you would qualify for $2 million of life insurance. So max funding your policy would be contributing whatever is necessary to achieve that $2 million of life insurance. So that's what that would look like.
Nathan says, how do we find out what our max insurability is?
Yep. It's kind of similar to the question that I just answered, right? It really depends on your age. I believe 20 to 30, it's 40 times your income. 30 to 40, it might be 35 times your income. 40 to 50, it's 30 times your income. And then I think the 50 to 60, it's that 20 times your income. Again, don't quote me on that part because I believe there's a break in there. And I think once you hit 60 and beyond, it becomes 10 times your income, and it goes down from there. So again, it's based off your age, it's based off your health, and it's based off this multiplier times your income.
Oh, okay. Greg's clarifying. He said, like, if and Greg, in the situation that we just shared
Mom is
with the
the
mom and
owner.
the daughter is actually the owner of her
Right.
policy, and
Right.
the mom is helping to fund that
That's
because
right.
that's how it has to be structured in order to get the best benefit.
And this is something that is usually very unclear in this process. So I appreciate the question, Greg, because it gives me an opportunity to kind of clear that up. So in this case, a parent can own policies on their kids. They can, not a problem. But once you reach that age, I want to say it's 25, you no longer are able to own a policy on your child. So because her daughter happens to be 30, she as the mother cannot own the policy on her daughter, but she can fund the policy, meaning she can provide the income necessary to be able to fund that policy. And matter of fact, in this case, they are both funding the policy, but the owner of the policy in this case is the 30-year-old daughter. Had she been 23, 22, or something like that, then yes, mom could own the policy on her. But to answer your question, if mom owns the policy on the child and mom passes, the beneficiary of that policy would hopefully either be a trust or the person that the policy is owned on. So it would be the daughter who would be the beneficiary. So if something happened to the mom, the transition of ownership would just move to the daughter in this case. So
Diva's got a good question. You know, this is like the tea is getting hot here. Okay, I'm just curious as to why this is not pushed versus term. Is it less commission for the people offering it? Well, let's get into it.
short answer is absolutely. MPI or most properly designed cash value life insurance products are designed like this: max funded option B, MAX, max funded option B. What does that mean? Max funded is saying we're purchasing the least amount of life insurance legally possible. Okay, why do you care if we're purchasing the least amount of life insurance legally possible? Well, how do life insurance people make their money? They make their money based off life insurance. So the more life insurance you buy, the more money I make as a life insurance guy. So why wouldn't I focus on making sure you purchase the most life insurance possible so that I make the largest commission possible? Well, in a properly designed product like this, it's about purchasing the least amount legally possible, meaning we want to get just the right amount of life insurance so that we don't underfund your policy so that you can get the compound interest accessible. So the reason most life insurance people don't push products like this is because they make less money. As a matter of fact, I'm not a life insurance company. We work with A+ rated life insurance companies for a product like this. So the life insurance companies who offer products like this have to be willing to make less money up front, that's a pretty powerful statement as well. Like, what life insurance companies do you know want to make less money so that you can be better structured so that you can build the compound interest necessary? Now, don't get me wrong. The life insurance company is going to make their money in the end. But the bottom line is, in order to have a properly designed secure compound interest account, the person providing it, me, the life insurance producer, the company providing it, the life insurance company, have to be willing to take less money up front so that you can produce a properly designed product.
And this is where we see a lot of pushback against MPI, because why would they want this to exist when this challenges how they have structured their agencies even? Mm-hmm. There are a lot of people who could become certified to offer an MPI plan. By the way, I wanted to make that note. When you say policies like this, you can't offer MPI unless you're certified. I just want to make sure to clarify that because there's a lot of people out there who are claiming that they can do the same thing as an MPI plan, and people don't know the difference until they've already put their money in, and then they go, crap, this guy said it was the exact same thing. There's no possible way. He was just making it seem like it was because he actually can't write an MPI policy.
And what makes MPI different? It's the leverage part. There's not a product you can find outside of premium financing that will allow you to bring leverage into the policy and create an arbitrage situation that allows your income to grow. It just does not exist. Now, you can take the policy loan and go do infinite banking, but that's outside of the policy. I'm talking about using leverage inside of the policy, meaning you've got that security of the general fund and you've got that the growth exponentially between what your money's making inside of it and the arbitrage being made with the cost of leverage plus what you're making. So there's not another product that exists like that.
Okay. Do you recommend ROP policies?
I don't know what ROP means.
Me neither. So Diva, can you tell us what you mean?
I don't know what ROP means.
I don't know. Moving on. I like Brenda's comment here. Leveraging our life to ensure our income. That's what she meant. And we need a t-shirt. But ensuring income is definitely something that does exist. For creators who are like TikTok and whatnot, there was an ad that was going around a while back that because you don't have guaranteed income, and a lot of them quit their jobs. So now you can opt in and you can pay few $100s every month, right? And in the event that something happens, like your account gets shut down or something like you hacked or whatnot, then you can get a payout from the insurance for your income. However, it's different because you're not doing anything, no different than car insurance. You're just paying in every month, and it's just another reason for somebody else to get paid. Now, I understand that this could be some protection for some people, but this went viral. They really thought this was a good idea. So I'm just going to put it out there. Insurance for your income is actually a how they're structuring some marketing for particular products, but it functions very much like car insurance, where you don't get to leverage any of it.
And it just dawned on me, RLP, return of premium.
Oh, got it. Okay.
That so to me, that's more of a gimmick because why would someone offer return of premium? Because I think inside of some of the policies I see, there's also this they call it a refund option at the end of 15 years. Why would a refund option even be offered? Why would return of premium even be offered? Well, if this is properly designed, if you were to take that option, then you're actually leaving money on the table if it's if it's properly designed. But for a poorly designed product, this absolutely is a possibility because what that's saying is you can become over leveraged, or you could become the cost of insurance could be so high that it could eat into your cash value. So therefore, there has to be these levers that can be pulled to help get you out of this situation. But if it's properly designed, those levers aren't required because there's not an issue with this policy imploding. And I kind of see that more as a lever used for poorly designed products. So I don't know if you meant it in that fashion, but that's kind of how I see it. So,
Yeah, she was saying that you get all your premiums back if you outlive the policy.
and most are designed. Most of the policies are designed for years 120. So at the 120th year, everything comes back to you because the policy pays out because you've outlived the policy.
That's it?
120. Yep, age 120. That's how most of the policies that I've seen structured. But you're right. There are those policies where they are, I'll call it up through age 90, if I'm not mistaken. That the return on premium policies are structured. But again, I call it that's a poor design there.
And again, this is my point about the family bank. If you have to wait until somebody kicks the bucket to have the hand up or to get the point of everything that they were putting in, you got to wait. Then all we're just creating cycles of waiting for people to why would anybody want you to live to 90? Right?
Well, it's because of the higher insurance premiums. In addition, meaning at age 90, you're paying a lot more in the cost of insurance at that age as well. So the thought process is this: in a properly designed product, it's initially designed, again, max funded, I talked about. Option B is saying the death benefit increases as the cash value increases. Well, if the death benefit is increasing, when you hit 90, the cost of insurance is so high, what should you do? Well, in a properly designed product, you should switch that from option B back to option A. So it's a level death benefit. So the cost of insurance doesn't eat into your policy. But again, I go back to design. I go back to structure. If you're dealing with someone who understands this, then they're going to design this product such that when you're hitting that point where it doesn't make sense to continue to have a forever increasing death benefit because the math starts to eat into, or the cost of insurance starts to eat into your profits, your cash value, then we make that adjustment such that that doesn't happen. Again, I go back to design. Design is key.
Yeah. Well, and I go back to, won't we just start waiting for people to kick the bucket so that we can afford to buy a house? Like our kids, their generation and beyond, they will absolutely be like, "Ah, when is grandma gonna go? Because we need." I'm just saying facts. It's just facts, right, guys? It's not. It may be harsh, but it's not. It's just true. They're looking for leverage. We can help each other build leverage and build wealth while we're here. It doesn't have to be that the reason why you walk into the room and you get respect in the room is because everyone's inheritance is coming from you. It could be that you're helping them build their own banks too from the family bank, right?
I agree. There's definitely a better way to approach this.
Yeah,
And
okay.
there's a better way collectively to work together to approach this.
Yeah. And then we can do better, and I won't have to say those types of things, but that doesn't make them untrue. Just saying it.
So for Lolo, it really depends on her income. If the multiplier is right around 20 times that income. So if she makes 100,000, if she makes 50,000, it really just depends on what that income would be. But the multiplier is 20 again. I believe it's 20. It's either 20 or 15, but I believe it's 20 from age 50 to 60, I believe.
And if you want to know what would be a policy would look like for you, what your numbers would look like, and you want your numbers to be ran by Donnell, then you can do that by going here and just book a call. But no, he is booking up for weeks. So get in there. Don't think about it. Jump in there now and at least get your appointment set so that you can get that consultation with him. And it's free.
And I know I did this to myself, but because I was off last week, I've really been trying to meet with as many people as possible I've been trying to move people from last week into this week. So I've been sliding them into different slots. So I know the length of my traditional meetings are right around 45 minutes, but I've been moving through these over the last few days, mainly because I've kind of doubled the number of people that I normally talk to, mainly because I did, again, I think I could have professionally handled this a little bit differently last week. So I just wanted to make sure I got people in as quickly as possible. So I apologize for the 15, 30-minute reviews. And I know I'm moving quickly. I know I'm throwing a lot at you. But so I appreciate your patience around all of that.
And Darden, we appreciate that feedback. We are trying to distinguish ourselves from what the reason for getting out here was that we saw what was being shared and there's just a lot of information missing. We are doing things in a different way and we hope that we can be the change that we wish to see in the world. And so that's how we can continue doing what we're doing and then it benefits only our family, right? Or we can say, hey, if we can start this channel, we can get out here and talk to other people, we can build a community, build our own family, essentially, that's all of you here with us, and then say, you guys are coming with us, and your families are coming with us. And so far, that is exactly what we're seeing, like just the way that we saw it, we said we have to do this. And just in that same way, we are watching families transform in front of us. And it's an honor, y'all, to watch this happen and to hear your stories and to watch you become inspired and then inspire others. And it's kind of been an each one teach one, right? We hear people who get on our on Donnell's calendar and they came from you guys. They didn't even find us on their own. And that's all of that is amazing. And that is how we're going to change the world. It's how we're going to change what wealth looks like too. Okay. Okay. So thank you, Darden, for that feedback. Okay. Rosanna says, hi, I'm a first timer. I've been watching for a while, love the information, still thinking about what's the goal at 56 for myself and my children. You guys are truly a blessing. Thank you so much, Rosanna. You're not alone.
Right.
Right here in the comments are other people who just like you, and it doesn't matter how old you are. The point is that you're starting.
That's it.
And we're moving forward.
It's a machine.
That's
the key
right.
is to start the machine. And if you do this right, and I've been saying this for years, we are all 2 generations away from generational wealth, 2 generations. So why not start? Why shouldn't it start with you?
Right. And it should. So the example that we had tonight was about a 60-year-old lady who called in, Miss Brenda. We called her Miss Brenda because we change the names when we do these case studies. Sometimes we just change the gender too, just for kicks. And so that you guys have privacy if we do share your story. She's 60 years old, but it didn't make sense for for the policy to be on her. And so we saw the difference in what it would look like if the policy was actually on her daughter. And so that's where all of this started from. Johnson's question is, can a 60-year-old start SGIA or MPI due to the time horizon available to him or her? And if you might have joined us late, so if you just take the scrub bar, scrub back, and you can see the example that we just went over and then come back and watch and join us back live while we're still on, then you'll be able to see that. You'll see the difference in what it looks like.
Yeah, and the short answer to that question is absolutely. But the question is, does it mathematically make the most sense?
Right. And sometimes that is someone's only option, but that doesn't mean we can't get creative. And I think sometimes people need to see what those options could look like so that they understand that where they could start to think of things differently. or that perspective. Okay. Doesn't matter what kind of income you're receiving. Example, if you currently only have retirement income, can I fund an MPI policy on myself if I qualify?
So if you're talking about using retirement income to fund your MPI plan, there's layers to that because I have a lot of clients who are retired military. Retired military are receiving some portion of their pension right now, even though they may not be at 59 and a half, which is traditional retirement age. So can they use a portion of that income or all of that income to be able to create or build or fund an MPI plan? Absolutely. As a fiduciary, can I, in good conscience, say, hey, yeah, take that tax and penalty hit and go ahead and use your 401k, 403b dollars to be able to fund your MPI plan? I can't. But I can say, what does the math say? And we can methodically look through, talk through this and understand what does make sense or what does not make sense as it relates to this. And I think it feeds right into Mike Bell's comment that I just saw here. I'll slide that because I think this feeds right into it as well.
I think
Have
it's
you
Miko. You're saying it wrong.
say Mike Bell? Nico,
Yeah,
my bad.
it's not Mike, it's Miko, I think.
I'm sorry.
Tell us if that's your name, Team Miko or Team Mike.
I'm Team Miko. I just was reading fast.
You keep saying Mike like 3 times now.
I appreciate that.
Yeah, well, that's what I'm here
Feedback
for.
makes the dream work. Is that how they go? Feedback makes the dream.
I got you.
Okay, thank you.
Okay.
So Miko Bell, have you had any case studies where they pulled from retirement account 401k, self-directed IRA, and take the penalty and max fund MPI versus staying in that self-directed retirement account and investing somewhere else? And actually, I think my first velocity banking example was around pulling from a retirement account, putting from leveraging a self-directed 401k, borrowing against it and doing velocity banking with it. I could have easily taken that same example, borrowing against a self-directed 401k and funding an MPI plan. Can you do that? Yes. I think the moral of the story is looking at the math. And to your point around using a self-directed retirement account, getting it out of the market and putting that money somewhere else and doing better than MPI or doing better than what it would be doing sitting in the market. There are vehicles out there. I am now, this is a short-term growth, but I invest in self-storage facilities. And getting my self-directed 401k out of the market and placing that money into self-storage has allowed me to achieve at times 20 up to 32% returns. MPI wishes it could. Now, can that self-storage facility produce that 32% in perpetuity? Probably not. But from a short-term perspective, absolutely. So are there opportunities out there where a self-directed retirement account can beat MPI? I can show it to you all day long. But when you talk about passive, being truly passive, being able to sleep well at night, knowing your money's working for you, producing a machine that also not only produces secure compound interest, but also a death benefit, now that's hard to beat.
Mailbox money.
Absolutely. And when you throw the death benefit on top of that, that's very hard to beat.
That's trust fund babies.
Absolutely. So I would call MPI more of a base hit type approach, meaning it's slow, steady, consistent growth over time that produces secure, uninterrupted compound interest. When you're talking about a self-directed retirement account, there are vehicles out there, but most of them are wins, holds are more of a home run approach. So I think that difference between which one is better is really based off time.
Think
Great
Thrival
question,
says, yeah, these are great questions. MPI is mortgage protection insurance.
It is. It is. I think MPI stands for something else as well. But in this case, MPI is a life insurance-based product designed to produce income.
I think she's thinking of PMI.
Well, but some people
Yeah.
call it MPI.
Yeah,
Like
they
I've seen
do.
it as well.
Yeah.
So let's distinguish. MPI is a premium finance strategy. So what is a premium finance strategy? Premium finance is a strategy that's been around since since right around the time Roth started. So around 1997 is when premium finance started. It's a strategy where the life insurance companies wanted to jump into building and creating a tax-free income for life, similar to what Roth does. And so what they decided to do was they started to bring in leverage from a bank, bring that leverage in and use that leverage from a bank to be able to build uninterrupted compound interest inside of the product, meaning using that leverage, creating an arbitrage situation to grow your premium or grow your cash value faster. Well, if you were to Google premium financing, in order to have a premium finance account, you only have to have $5 million dollars in net worth. You only have to have a super great credit score to be able to participate. Well, right around 2014, 27, between 2014 and 2017, the guy that created MPI, Curtis Ray, came up with this concept of, hey, why do I need bank support to have a premium finance strategy? Why can't I use my own cash value to be able to do so? So MPI was created around then, and it kind of hit the mainstream around that 2017, 2018 timeframe. So MPI, maximum premium financing, MPI, maximum premium indexing, absolutely has a different meaning alongside with MPI as in mortgage protection. So I get that where that confusion might come from, but just know this: MPI, maximum premium indexing, will replace traditional retirement planning. Give us a few years. It will replace what we know today as your 403b, your 401k, your IRA, your TSP, your government 457 plan. And why is that? It's because security. What MPI provides that traditional retirement accounts can't is security. The ability to build uninterrupted compound interest and not be concerned as to who's president, what's happening in the market, whether or not Elon Musk did or didn't go into space. It that even matters. It gives you the ability to build secure uninterrupted compound interest using a life insurance based product to do so. So appreciate that.
All right.
Nico?
It's a nickname. It's Michael. You win. I was wrong. No, I'm sorry. I was wrong, though. I just wanted to apologize. And I wanted to say you were right.
Well, just one more time, because I can hear you my earphone.
I was wrong.
But you're pretty when you're wrong.
And I'm sorry.
Girl, let's get out of here.
All right. Well, I want to make sure we got all the questions answered. Okay. So it sounds to me like talking about systems to create a family bank might be something that you guys are more interested in getting more information on. So that's good. So we need that feedback. And then I do think we've covered everything. Rosanna, I thought we had one more. She said, what's the best way to grow money that sits in a savings account?
I'm a fan of high yield savings accounts because we all need places to let our money sit for a minute. So I am a fan of them, but the best thing you can do is get your money out of that savings account, get your money out of that checking account, and get your money moving. The best way to build compound interest is have your money moving. So you need to put it in a vehicle where it's actually working for you. Put it in a vehicle where it can go recruit other money, where it can go build its own employees. And where would you do something like that? Again, I am a fan of a high yield savings account. I've got one. Like, I am a fan. But to me, that's a temporary move. If we're talking about building wealth and generating a secure compound interest, it has to be in a vehicle where it's working for you. And there's very few vehicles out there that give you the security you need to not have to worry about, again, who's president, what's inflation, what's happening in the stock market. Like, if you're looking for security, I've yet to see one that can outperform a secure compound interest account. Like a premium finance strategy called MPI. There may be others out there. Real estate is awesome. Don't get me wrong, but you mentioned your savings. The best thing you can do is put your money in a savings account, like a secure compound interest account, and get your money working for you, because a SKIA is a savings account.
Yeah. The other thing is that your money sitting at a bank is just giving the bank a free loan. So they may be kicking you back some coin just for having it in there, and they make it sound like it's a great deal. But you take that money out, you're no longer getting, you can't leverage it. It's not growing if you're leveraging it. So there's a lot of things that I think, and we did the comparison on that. A high yield savings account versus what they're calling a hybrid IUL, which is like some fancy marketing for trying to be an MPI plan. That's just the truth. And then we also compared it to a SKIA with MPI. So that already exists. Just look for that thumbnail or type it in there, and then you'll find that comparison. It's head to head. So we tried to do the best that we could there. Okay, one last one. Follow up. Would booking a consultation be strictly for MPI consideration, or is it for a general 30,000 foot view of my financial status? If it's been already answered, I will rewatch later. So Darden, this is a great question, and I'm going to throw in before you answer this question, because there are so many times when I hear you on the phone with people and you ask them, what is your goal? Whatever they tell you your goal is, you don't tell them what their goal should be. You hear what they said their goal was. And then at the very end, after you've had this whole conversation, the 30,000 foot view conversation about their goal, then they go, well, what about MPI? Aren't you going to tell me about MPI? And you go, well, that's not what the conversation you were trying to have. The conversation you wanted to have was this. And so now we have to book another call because now we're out of time. However, yes, we can talk about that. But I'm not here to tell you to do something that you said you didn't want to do. So I appreciate that you don't push people. But I think people are looking for you to find out where MPI fits or could fit in their plan. And you're waiting for them to say, please tell me. That's what I want you to hear from you on.
Yeah, I am not a tax attorney. I'm not a financial advisor. This is not financial advice. I'm an engineer who became a retirement consultant. And what that means is when you reach out to me, my objective is to help you build income. So if you tell me I've got these properties and I'm looking to do these things with it, I'm going to ask you why. I'm going to ask you, what is your goal? What is the point? What is the purpose of this call? What is your goal? And I'm listening for certain words. When you tell me legacy, when you tell me retire early, when you tell me words that conflict with what it is we're actually talking about, then I'm going to bring up strategies around how to actually hit your goal. Because again, I'm asking you what the goal is. I'm not here to tell you what your goal is. So to your point, when you book a call with me, it's really to review or discuss what it is you want to review and or discuss. When we go down certain paths, there's only a few different ways we can hit your goal. If you tell me you're a real estate investor and you want to learn how to leverage your real estate more effectively, okay, we can talk through that. If you have a previous employer's plan and you want to know how to access that previous employer's plan to be able to invest in what you want when you want, okay, we can go through that. If you're looking to do velocity banking because you wanting to leverage your assets a little bit better to be able to eliminate debt, reduce debt, or whatever the case may be, yeah, we can absolutely talk through that. If you have a cash value life insurance product and you wanting to be able to leverage that a little bit better to be able to do infinite banking, buy assets, pay bills, again, leverage to be able to do what you want to do, again, we can do all of that. But when you start saying, I'm interested in building generational wealth, you know what? I want my WTF moment. I want to generate wealth. I want to have full control over my time to be able to do what I want, when I want, and I want true freedom. I want to be able to go where I want, when I want, with who I want, however I want to go about it. Well, my question is going to be, what vehicles do you have in place right now to achieve that? And my other question is going to be, when do you want to achieve it? So if you're in your 30s and your goal is to wait till 65, then a traditional retirement plan could probably get you there. But when we start talking about income, we start talking about legacy, and we start talking about wealth, what you end up learning is the 4% hurts your ability to do that. So then what other opportunities are there? If you've got traditional retirement accounts that you want to be able to leverage and do other things, okay, they can only get you so far. When you start talking about WTF and wealth and time and freedom, again, it's hard to keep a secure compound interest account out of the equation, but I'm not here to push that on you. I'm not here to sell you at all. What I'm here to do is talk through where your opportunities are, talk through what your goal is, and my objective is to help you hit your goal. And I think that's the moral of the story.
All right, one more. Tyrone says, do you have to fund the MPI with a lump sum initially, or is it broken down into monthly payments?
Yep, you have a choice. You can put in a lump sum if you would like, or you can absolutely fund your policy with just the monthly income. Now, the ask is if you're going to apply a lump sum that you do some portion of a monthly amount just so that you can get that secure compound interest over time. But if you don't want to put in a lump sum, you don't have to.
And speaking of time, it is the most valuable asset that we have. And that was really at the core of the example that we went over tonight, was that she doesn't have time. And by the time she realized she doesn't have the time to put some sort of plan into place, she doesn't have the time to come back from risk. She doesn't have the time. So she has to be very smart and strategic about her time horizon now. Her daughter has the time, but does that mean she needs to use all that time? And what we learned is that not only could the mother take advantage of and hit her goal, but the daughter could do something that wasn't even on the table before. She could retire early. And she hadn't even considered it because it's just not a part of the normal conversation.
Right. There's not a vehicle out here that will allow you to do that.
Right. So she wasn't even considering it. Right. But a lot of these other vehicles too, even if you could retire early, even if your retirement plan or your accounts have enough in there, you're penalized for taking it early. So, it's kind of like 6 one way, half a dozen the other, unless you gain full control and you get out from underneath these systems that are not designed to benefit us, any of us. They are designed to first benefit the people who they were structured for, which are employers and a ton of other industries that have thrived as a result of them coming into our history, because they've come one after another. If you want to see what the history of those retirement accounts are, we put them along together with the story of Wizard of Oz. Weird how it all lined up, but that might be fascinating for you. I was highly entertained by the entire thing and distracted. Yeah. And distracted because I tried to put the music in there, but I kind of threw me off a little bit. Point is, time is the most valuable asset. And because of that, we appreciate that you guys are spending your time here with us. We tried to structure these now so that we're not going as long, knowing that it's an investment of your time to be with us. And we really do appreciate that. So on that note, we know that time is valuable, and thank you for tuning in. But we also like to say that if you don't come from a wealthy family,
we can make sure that a wealthy family comes from you.
That's right. So stay focused.
Stay protected.
Stay tuned.
Stay connected.
I'm Angelique.
And I'm Donnell.
And our goal is to help you
get self-directed.
And we have a ton of free resources to help you do that. So stay tuned, and I'll put them on the screen right now. And then we'll see you guys back on Sunday.
Have a good evening.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get self-directed.